My name is Dave Osmond. It'll be my pleasure to introduce our special webinar today for Martin Pring's Special K. Before we start, I want to start with our standard disclosure. Using this demonstration here, this demonstration is designed to instruct you on using Metastock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Well, I want to just introduce you very quickly here to Martin, who's a good friend of Metastock. He founded Pring Research in 1981. He publishes the Intermarket Review. He's an author of Technical Analysis Explained, recipient of many awards, and honorary member of the Swiss Technical Society. Martin has been a long-time friend and user of Metastock. We are very glad to have him here today with you, and I'll go ahead and turn the time over to you, Martin.
Okay, thank you, Dan. Okay, this afternoon I'm going to be talking about the Special K and specifically about the package which Metastock has to offer. But before I do that, I'd like to just give you a little bit of theory behind the Special K, because it's really built on another indicator I developed back in the 1980s, which is called the KST. And the KST rationale rests on several things. First of all, it assumes that price at any one time is determined by the interaction of a number of different time cycles, as reflected in trends. And that's what this next diagram shows you. It shows three trends, or it will when I remember to click on the arrow here. So the main trend and the dominant trend is the primary trend. And the primary trend lasts from 9 months to 2 years and revolves around the so-called 4-year business cycle. And it dominates the characteristics of the other trends. But just as the primary trend doesn't move up and down in a straight line, it's interrupted by another trend, which is the next one down, which is what we call the intermediate trend. And the intermediate trend, excuse me 1 second, my screen went blank there. The intermediate trend lasts anywhere from 6 weeks to 9 months, sometimes as little as 3 weeks, some people say, but I like to think of it more as 6 weeks to 9 months. And the rationale for the intermediate trend is usually pretty obvious at the time, because there's some event that comes up which is very believable. So, for example, if we're looking at the stock market and we take this point just here, the peak in the intermediate trend, at that point could well be caused by the fact the economy is starting to improve. Fed decides to raise the interest rates. People in the stock market say, well, interest rates are rising. We better get out of stocks because another recession is coming. That's what's going to happen. Well, that causes an intermediate decline to take place, but at the bottom of the decline, people realize that interest rates may be going up, but profits are going up even faster. So that allows them to buy stocks at that point there, leading up to the final peak in the stock market. Over here at this point, by this other green line, we may find that the intermediate sell-off was caused by the fact that people thought the economy was slowing down, and at this point around here, and so they decided they were going to sell the stocks because they see interest rates going up and they see the economy weakening. But then at this point, just here by the second green arrow on the right, some good economic numbers might come in, and maybe people think that, well, the recovery is going to continue after all. So there's always a good reason why you have these intermediate ups and downs, and they're very believable. Then finally, we have the third trend, which is the short-term trend, which lasts on average between 2 and 6 weeks. So at any one particular point in time, we've got the interaction of these three trends: the primary trend, the intermediate trend and the short-term trend. And perhaps the most important point of all from this diagram is the fact that when you're in a primary bull market, the direction, the upward direction, dominates the characteristic of the short-term price moves. So in other words, we have all the magnitude is on the upside during a primary bull market, whereas during a primary bear market, the magnitude is on the downside. And if you're going to get any buy signals with short-term indicators, typically that's when you're going to get whipsaw signals, when you're in a bear market. And that's very important to try to understand the difference between a primary bull market and a primary bear market. Obviously, for long-term investors, it's pretty evident why you want to know which direction the primary trend is. But even short-term traders need to know, because short-term rallies in a bear market are going to cause you a lot of grief. So you want to have some idea that you're buying in a short-term bull market. I should say a short-term trend in a primary bull market. So the second rationale for the KST is the principle of commonality that states the greater the number of cycles moving in a particular direction, the stronger the price move. And that's what we see in this diagram here. Here we've got the S&P composite with 3 different rates of change. And if we look at this point here by the vertical green line, we see that the market goes flat for a while. And the reason is because we have one momentum indicator moving up, the 6-month rate of change, one going sideways, and the 12-month is coming down. So you've got 3 different cycles moving in different directions, up, sideways, and down. So the offset is basically for prices to move sideways too. Then the next stage we see prices move up a little bit more, and you can see that the 6-month rate of change is now joined in the bullish camp by the 9-month rate of change, and the 12-month rate of change is still declining. So as we move on a bit more, we have another vertical line, and to the right of that vertical line, you see the market accelerates at a faster pace. And the reason is that all 3 momentum indicators, which are all reflecting different time cycles, are all moving up in the same, or they're all moving up, I should say. So that means you've got commonality. And that's another of the things that we look for in the KST. And finally, in the KST, when I was designing it, I wanted an indicator that follows the broad swings of a specific trend, but which also turns on a relatively timely and consistent basis. So what we're really trying to do is to try to get the broad trend. And so what we're trying to do with the long-term KST is just get something, an indicator that reflects the primary trend, the trend that moves up and down for 9 months to 2 years. And so on this slide here, we see the S&P composite, and underneath is the smooth 24-month rate of change. And you can see that that does reflect the long-term swings in the market. So underneath you have the long-term KST, and if we do the same thing for the long-term KST, you can see that it also reflects the long-term swings in the market. Now the problem is that the smooth rate of change, which is a 9-month moving average of a 24-month rate of change, does reflect the broad movements, but it tends to turn relatively slowly. And in the markets, if you've got a 2-month lag, that obviously can be a very costly event. So we want an indicator that turns more quickly. So what I'm going to do is I'm going to take away all this other peripheral stuff and then overlay the green line, which is the KST, over the brown line. And you can see that the construction of the KST, because it includes shorter term time frames as well as the 24-month time frame, the green line does in fact turn ahead of the brown line in virtually every cyclical turning point. So here we see the KST in its compared to the S&P composite in the 1960s and 1970s. And this is when the market was moving up in a very cyclic way. And so the KST also did the same thing. And the idea here is that with the KST trying to reflect that green primary trend we saw in the theoretical diagram, when it starts to turn over, it's really reflecting a distribution phase in the market. It doesn't catch it immediately on every turn, but basically speaking, when the KST starts to roll over and turn over, you've entered this distribution phase, as we see in these three shaded red boxes. So that's the ideal way in which the KST will work. Unfortunately, there are some situations when any momentum indicator is going to fail. And one of them is shown on the chart now, like we saw in the S&P between the 1984 and 1999. That's what we call a secular bull market, a linear trend. And in a linear trend, you're going to get a lot of false signals with your primary trend signals because of the nature of the characteristic of the market. We saw the same thing in Japan in the 1970s and 1980s as well. And there, any long-term momentum indicator you use would not work. And that's unfortunately a fact of life. Also, something like the 1987 crash, which is a random event, or something like we saw in the Tiananmen Square massacre in 1989 in Hong Kong, those random events are not going to get picked up by these slow-moving indicators. But virtually every market, most of the time, is going to be revolving around the business cycle, which unfolds in a slow and deliberate manner. And so it will work. So why do you want to use the KST and not something like the stochastic? Well, here you see I've got a 24, 15, 10 stochastic. That would be a 24% K, a 15 slowing factor, and a 10 factor for %D. And above that is the KST, and what I'm doing now is just showing you that the KST reflects all the long-term moves by the stochastic. And by the way, this is the best formula I could find for the stochastic, which reflected the KST. So you see the KST leads the stochastic on virtually every turn. Here's a couple of instances where they coincided, and there's actually one instance here at this peak here where the KST lagged the stochastic. So what I'm saying to you is if you don't have the KST, if you're using Metastock, of course, you do have the KST. Anyone who doesn't have that could substitute the stochastic, but it wouldn't be as good as the KST. It would get you probably 75 to 80% of the way there. And here are the same thing, looking at the bottoms, where the KST tends to lead the stochastic. So some of the problems with the long-term KST is that, as we discovered, although it's quicker than, we'll say, the 9-month moving average of the 24-month rate of change, the long-term KST can be slow to turn. Another thing is it doesn't reflect the waves of the short and intermediate series, so you lose that when you plot the long-term KST. And it doesn't generate short-term signals, it only generates long-term signals. So I got thinking about that, and I thought, well, what could we do to improve the KST to give us some of these long-term turning points at a relatively early stage? And also another indicator, the same indicator, which would reflect what's going on with the short and intermediate term time frames, and yet could also generate short-term signals. So if you're an investor, you can look at the long-term swings in this indicator and say, okay, I'm going to buy when it's down and sell when it's up. But people who are trading for a 2 to 6 week period could also lose the same indicator to trade with. And that's when I came up with the idea of the special K. So this is the special K in theory here, where what we're doing is we're taking away the primary trend. Oh, I should say, ideally what we want to do is to see an indicator peaks right when the market peaks and troughs right when the market troughs. And something that turns relatively early, certainly more early than that green primary trend curve. So what we're going to do now is we strip away the primary trend, and we're going to strip away the intermediate trend, change the nature of the short-term trend, and give it a new name. So that now becomes the special K. So the special K, in effect, is the sum of the long-term KST, the intermediate KST, because we have KSTs that measure intermediate trends, and we also have them for measuring the short-term. So the special K is a sum of all those three trends. So here's a theoretical special K just here, and underneath and it's showing underneath the price. So ideally, we want the special K, just as our theoretical diagram, to peak within a few days of the actual market peak, and to trough in a few days or so of the market trough. And generally speaking, in the example I'm going to show you, you'll see that that actually does happen. But once again, remember that example of the S&P, the linear trend that I showed you, and the example I showed you of the Japanese market, or the example I gave of the Japanese market. This indicator is going to be subject to the same problems in the sense that it's going to peak prematurely. But in virtually most situations, you'll find that the special K peaks and troughs along with the market within a few days or so. So the benefit of hindsight, it's obviously pretty simple to see that that was the peak and over here was the bottom. So we have to come up with some techniques for trying to determine when the special K has reversed direction. And the simplest technique I've ever come up with, and actually the most effective when you can draw them, is just to draw a trend line on the special K, a trend line on the price, and when you get a joint violation, that signals that the primary trend has reversed. So that's valuable information to have. If you know the primary trend is reversed from up to down, then you don't want to be trading short-term moves from the upside. You want to be trading them from the short side, and vice versa. So another way in which you can figure out the direction of the special K is just to look at the short-term ups and downs, and when you get a series of declining peaks and troughs, that signals that the trend has reversed, the primary trend is reversed. So it's another way of identifying reversals in the special K. Sometimes the special K will complete price patterns. I'm going to show you a few of these that have just been formed on a couple of markets, indicating that we're probably in a bear market for equities in a few minutes. So that's another way. It's not just limited to head and shoulders. You can use rectangles, triangles, all kinds of things. Another thing to do is to run a moving average through the special K. And when the special K is above a moving average, that indicates a bullish period, as we have in the green shading, and when it's below, that indicates a bearish period, as far as the special K is concerned. And that's, as you'll see later, is a basis for some of the experts and some of the expirations that come with the package. So here's the CRB composite, here's the special K, and these green arrows show you that the special K does in fact bottom along with the price in all of these situations here. Pretty similar. And here are the peaks. Same thing. Now in technical analysis we know that nothing is perfect, so what I'm going to do is put in some dashed arrows. When I put a dashed arrow in, it means the principle I'm talking about doesn't work very well in that particular instance. And you can see that in those cases there, what was supposed to be a bottom wasn't a bottom, and what was supposed to be a peak in 2003, 2004 wasn't, because this is a linear trend. We're assuming that markets move up for a couple of years or a year and then start to move down. But this CRB composites bottomed out in 2001 and kept going until 2006 before it had a correction. But by and large, you can see that the special K does peak and trough with the market. So the special K then gives us some cyclicality of the short, the intermediate, and the long-term trends. It's capable of signaling reversals in the primary trend at a relatively early stage. And 3, it points us in the direction of the primary trend and helps us to determine its maturity. Finally, which we'll get to a little bit later, it signals or triggers short-term buy and sell signals within the context of a primary bull or a primary bear market. So the special K has 2 arrangements depending on whether we're considering daily or weekly data. And it has 2 templates which come with the special K package, the weekly and the daily. So let's look at the weekly first of all. What it consists of is the price at the top with a moving average, and underneath is the special K, and underneath that is the long-term KST. And we put the long-term KST in there because that's a smooth version of the special K. And in virtually every situation, you'll find that the special K turns ahead of the long-term KST because it includes the short-term and the intermediate KSTs in its formula. So there you can see that the special K does indeed turn ahead of the long-term KST. So we have this arrangement in order to see the special K, which is very jagged, and then bring us back to reality with the long-term KST, which shows us the true, slow, deliberate up and down of the primary trend. But the special K turns ahead of that. And so one of the ways in which we use the special K is to draw trend lines. It's a very simple approach, but it's an extraordinarily effective approach. And I can't tell you how many times I've spotted primary trend reversals by looking at a lengthy line, trend line in the special K, getting that confirmed by the price, and then you see a change in trend. So we see the same thing throughout this chart, where you can have this setup, drawing charts, drawing trend lines, and waiting for their reversals. A very effective tool indeed. The drawback, or the only downside with it, of course, is because you're drawing long-term trend lines, you can't draw them that often. But when you look at a lot of different markets and sectors and cross-sector relationships, commodities and so forth, it's amazing how often these lines can be drawn. So just to prove that not everything works, here's a combination which in theory should have worked, but again it was a linear uptrend, and with that trend line violation in the DJP, the Dow Jones, actually it's called the UBS ETF now, commodity ETF, it didn't work. So there are going to be situations where you get these linear trends where none of this stuff is going to work, and that unfortunately is a fact of life. The good news, of course, is that it works most of the time. So another way in which we can identify reversals in the direction of the special K is when the special K crosses above and below its moving average. And the moving average, as shown in the template that comes with the package, is a 26-week moving average of a 52-week moving average. So it's a 26-week smoothing of a 52-week moving average. So these arrows show when the special K crosses above and below the moving average, and it's given some pretty timely signals. Unfortunately, when you're using moving averages, you're also subject to whipsaw. So those items in the ellipses, or the price action in the ellipses, shows you some false or whipsaw signals. Not too many, fortunately. I mean, this goes between 1999 and 2008, so that's nearly 20 years. And we saw 3 whipsaws in 20 years, which isn't bad. So that was the weekly template. And now we look at the daily template, which is a second main arrangement of looking with the special K. And the idea here is that the special K goes up and down. And when it goes up, it's telling you the momentum is up, and therefore the trend of the price is up. But it doesn't tell you whether it's oversold or overbought. So that's why I put the daily KST underneath, because the daily KST will tell you whether or not the market's overbought or oversold. And you can see here these arrows now point up the peaks in the special K and the KST, and you can see they line up pretty closely. And we can do the same thing for the troughs. So you see there is a very, very close relationship between the KST and the special K. So the KST helps you determine whether or not the market is short-term overbought or oversold. And the special K puts the whole thing in a very broad context of where we are in terms of the primary trend. So this chart was plotted with yesterday's data. This is the MSCI Europe, Australia, Far East ETF, the EFA. It's basically the rest of the world, with apologies to South America and to Canada, which isn't included in the index. But I put it up here to show you where we are now in terms of KST and special K analysis. So first of all, it called the bear market very nicely with 2 beautiful trend lines. And incidentally, what I call a beautiful trend line is a long a long line and a line which has been touched or approached on numerous occasions. And both those trend lines qualify in spades as a beautiful trend line, or as beautiful trend lines. And here's a couple of trend lines that called the bottom, not so beautiful because they're not as long, and certainly the one on the price has not been touched or approached on so many occasions. But now what we see is the special K. I don't know if you can see this, but the special K as of yesterday's close, and today of course it will be even worse, broke below the neckline of a Head and Shoulders top, indicating that the special K typically will lead the price, indicating that the special K has now rolled over and give us a bearish signal. And you notice also during the rally that we had in March and April, the price went above its 200-day moving average, but the special K was unable to cross above its average. It was really unable to cross above zero in a similar manner to as it was in this period over here. So the special K has definitely gone bearish. The price itself is resting on the neckline of a Head and Shoulders. So I put a question mark there because until it breaks to the downside, it's not confirming the special K. But what it does, it suggests to me that the rest of the world, excluding the US, is in a primary bear market, because that will also indicate declining peaks and troughs at that point. You may be thinking, well, the US market's going to get away and it's going to be okay because it's actually been outperforming the rest of the world very, very nicely for the last year or so. But here's the NYSE composite. We're using the same trendline analysis here, and you can see that the NYSE composite has also completed a Head and Shoulders top with its special K. The special K has broken below the neckline. It never really seriously went above its moving average here. The NYSE composite is actually below its 200-day moving average right now, and if it breaks this trend line here, I think that's going to be giving us a very serious signal. Remember, the NYSE is the broadest measure of capitalization of NYSE stocks. The S&P composite only has the 500 stocks. The NYSE is a much broader, a much more important measure of the market, in my view. So we could use the special K for identifying major trend reversals, which we've just done. But it's also good for timing pro-trend short-term moves. You remember that diagram I showed you where we had the primary trend going up, and I said all the magnitude on the upside is on the left-hand part of the chart when the primary trend is rising. That's when short-term moves tend to work out. So what we have here is the S&P and a special K, and this time I'm showing you the 100-day, the moving average on the daily template is a 100-day moving average smoothed by another 100-day moving average. So once again, when the special K is above it, that indicates a bullish special K, a primary trend bullish special K like that. And when it falls below it, that indicates a primary trend reversal. Obviously, that was a temporary whipsaw signal. But by and large, this works reasonably well. Another way in which we can identify primary trend reversals, as we've done here, is to draw a trend line. And the reason, as we saw before, but the reason I'm drawing this trend line is this trend line is in the same area as the moving average. Both of these things, the moving average and the trend line, represent dynamic levels of support and resistance. So that means that they're both in the same area. They reinforce each other as a support or resistance level. In this case, it's resistance. And then another way in which we can use the KST, which we did in the theoretical example, is to identify a reversal in the peaks and troughs. And when you get a reversal in the peaks and troughs, as you have just here, that indicates a primary trend reversal for the special K. So here you see it's oversold, and it's in a bull market, so that gives us a good buy signal. Put that back there again. So you see this is a good signal because this is a pro-trend signal, because the special K is in a positive trend. The market gets oversold, and that gives us a good rally. Whereas over here, market's overbought, but now we're in a defined a defined primary bear market because special K is decisively below its moving average. And there you see quite a bit of magnitude on the downside. There again we see an overbought condition and a sell signal on a small decline. But the real reason I'm showing you this chart is because sometimes you get a divergence between the special K, which is moving down, and the daily KST, which is moving up. And generally speaking, if you're looking for the truth, you go to the special K, not so much for the KST, because the special K also includes the short and intermediate series. There we go. So this was supposed to show you that, and I don't quite what happened to the animation here, but I had a horizontal line, a dashed horizontal line that went across here. And the point I was going to make was that when you cross below here, below this low here, it's a new low for the special K, and you should expect the price to follow suit. Again, if you're looking for the truth, go to the special K, because the special K almost invariably will lead the price and give you a good indication of that, except in these linear trends, of course. So here we see the same sort of idea, but in where the KST is making a lower low at B than it is at A, but you can see what happens to the special K. It makes a higher low, and that's a positive signal indicating that the uptrend is likely still intact. So here's the point I was trying to make over here, but in a reverse sort of way, where the special K moves to a new high above this particular little high here, and that's confirmed by the price moving to a new high. So this actually moves slightly ahead of the price and indicated that the price was likely to follow suit. So as long as the special K is moving up, the chances are the price is going to move up, because in most situations, remember, the special K and the price typically peak and trough simultaneously. So what's in the package of the special K? Well, we have a complete course on the theory and application of this unique indicator, both in video and in text format. It's in the text format in the form of the manual, and there's a 45-minute video that explains just about everything I've explained so far and a lot more. We give you the historical data to plot it, because a lot of the stuff, as you'll see later, it comes in templates, it comes in layouts, so you need the data to be able to plot the data. And for because the special K requires a lot of data, it requires 4 years of data, so we give you lots of historical data. Sometimes what happens with some of the commodities, but it's spliced to the ETFs, because the ETFs, or the ETNs I should say, have only been trading for a short period. We slice the commodities of those particular ETNs back sometimes as far as 1973, depending on whether the historical data is available. Same thing with all the sectors. The sectors all go back to 1989, or the SPDR sectors go back, and so forth. Same thing with the international markets. So we give you the templates that comply. You can apply to the indicator any security with 4 years of historical data. And that would be the weekly template and the monthly template and some other templates, which we'll get into a little bit later. We also provide you with layouts, which provide a convenient and super quick method for plotting the sectors. These are the S&P sectors, and they're also the Dow Jones sectors, international ETFs and commodities, and both on an absolute and relative basis. So if you had a commodity, it would plot the commodity on a relative basis, not to the S&P, but to the Dow Jones UBS commodity ETF, which I use as the kind of the commodity equivalent, because it's a very broad, of the S&P, because it's a very broadly based commodity index. And if we're looking at international stock markets, we look at the MSCI World Stock Index, because we want to measure stocks, international markets, relative to that. So let's take a look at some of the layouts. First of all, the absolute price layouts, which occur for sectors, countries, and commodities. And this is the daily layout, just here with the special K and the daily KST. And I put this one in because it's really interesting for the dollar index right now. Previously, the KST, the special K, lent itself very nicely to identifying primary reversals in the US dollar index. You can see these combinations that I'm showing you right now. And they all resulted in primary trend reversals in the dollar. And then we saw a nice reversal back in August of last year. You may think, well, the horse is out of the barn now, because the dollar index has risen from, what, around 76 to 82 or so now. This is plotted up to yesterday, by the way. But if you look at the latest data, it's just completed, the dollar index and the special K have just completed reverse head and shoulders patterns. So my experience is when the two trend lines, the closer the two trend lines are violated, i.e. the trend line for the special K and for the dollar index or whatever the price you're measuring, the stronger the signal tends to be. And also if the price moves ahead of the special K, that's unusual too. That tends to be a strong signal. So we've got an unequivocal signal here that the the dollar index is going to be moving higher here. So that's the absolute price layout, which I also showed you earlier, some other examples. Then we can look at relative strength layouts. And a special K in relative strength action is particularly helpful because linear trends do not lend themselves well to momentum interpretation, as I mentioned earlier. But so the special K assumes a 4-year business cycle in its calculation. So it doesn't do well when a cycle is substantially different, either truncated much shorter or alternatively much longer. But relative strength is something very special. Sector rotation is very cyclical. It very rarely is linear in its characteristics. So that means the special K works very, very well on relative action. Sometimes, as we saw with the S&P in the 1980s, the linear stuff gives you premature sell signals. That's not true on the relative strength, anywhere near as much as it is on the absolute prices. So here we see the S&P Financial, the XLF, relative to the S&P, the SPY. And what I've drawn here, so that means that when this ratio is moving up, it means the financials are outperforming, and when it's moving down, it means they're underperforming. So you obviously want to be in sectors and stocks that are outperforming the market. So you want the line to be rising. And these arrows here are just to point out the peaks and troughs in the special K do correspond with peaks and troughs in this relative indicator. Then we can also look at this trend line analysis again, which I'm repeating time and time again. You can see how it works almost like clockwork here, with a great sell signal in the bear market 2007, 2008. Now we're doing more up-to-date chart with the healthcare, the IYH divided by the SPY. And this is plotted as of yesterday, and you can see there was a great buy signal when the special K and the relative line both violated important trend lines. Just because this line is moving up, it doesn't mean to say the healthcare stocks are moving up. It means that they're outperforming the market, and that's half the battle. If you can get into a sector which is outperforming the market, that's half the battle. So you really also need to go and look at the price itself to make sure the price itself is in an uptrend. So now, if we bring this up more up to date, you can see that very recently, I think it was last week, the healthcare relative strength line broke out of a huge base, and this base goes back to 2009, so we've got 3 years in length. And we got another base in the special K, and that broke out of that too, indicating not necessarily healthcare stocks are going to go up, but that they're going to outperform the market. And if you think the market's going up from here, then this is a place that you should definitely be. So we have the relative strength layouts, and another set of layouts that we have is what I call my Nirvana layouts. I call them Nirvana because they tell me just about everything I want to know about the long-term picture of a security. It starts off, it's got 4 panels to it. First one is the price. In this case, it's the Spider Home Builders. Underneath is a special K for the price. So that gives me a full picture on the absolute price. And then underneath that is the relative strength of the home builders to the SPY. And underneath that is the relative special K. So this is the special K of this relative strength relationship. And I bring it up now to show you that when you get all 4 trend lines, you can draw 4 trend lines for all series. This is very positive because it tells you that the home builder's price is going up with the absolute confirmation here. And it tells you it's likely going up at a faster pace than the market because the relative strength has broken its trend and the relative K has broken its trend. It's about as perfect as you can get a signal. Does it mean that it's guaranteed to go up? No, because in technical analysis, nothing is guaranteed, but it does increase the probability. Then over here we see the sell signal, which signaled the demise of housing for the next few years. And I show it to you today because the XHB has broken out of a nice base here. The special K had already done this a while ago, but the relative KST has only just started the relative strength action is only just started to break out, and that's also confirmed with the special K for relative strength. So that, to me, looks like it should be a pretty good sector. what happens when you get a deflationary type environment, as I believe we are in now, home builders tend to do very well, and so that fits with the environment. Because right now, the underperforming sectors are things like energy, industrials, and metals and mining. That's late cycle stuff, not the early cycle stuff. Stock market that tends to do well at the end of the cycle is Canada, and here we see the Canadian ETF, the EWC, and you can see how this combination here of trendline violations helped identify a reversal in the fortunes of the Canadian ETF. This is plotted as of yesterday. You can see the ETF itself is resting on the neckline of a potential head and shoulders. You can't say it's a head and shoulders until it's broken, but it does fit in with the idea that resource-based countries and resource-based stocks begun a period of underperformance, as you can see from the next two trend lines, and that is likely to continue. And you can also see that the Canadian ETF is below its moving average, which in this case is the 200-day moving average. And then I have another animation which is coming out of order, but it shows you how the four, this one, that one, and that one, all signaled the bear market. Not the characteristic of the bear market being a waterfall decline, but that a bear market was underway. So right now we're in a very similar situation where the special K is complete head and shoulders top. The price itself is resting on the neckline, and remember where the special K goes, the price usually goes, and certainly Canadian market is in a series an underperforming trend here. So we also have, and the final thing on layouts is cross-sector layouts. And what we do here is we have a whole series of layouts where we look at each sector and compare it to every other sector. So in this case here, what we're doing is I've taken one of the charts from the home builders comparison chart. In this case, I've compared them to gold shares, again to emphasize where we are at the present time, because this is completely up to date here. The horse is obviously out of the barn here, because this is now very overextended, but it's going up. It means that home builders are outperforming gold shares. You can see they were underperforming in this whole period from 2005 to 2011 or so. And now the home builders are in charge. They're beating the gold shares. A little bit overextended. I wouldn't be surprised to see this pull back. The reason I showed you the slide is because we have these sectors against every other sector. So you take financials against bonds, financials against utilities, financials against metal and mining, and all the way through to, and they're all done in a chronological sequence as you'd expect to see them done in the cycle. So to give you a bird's eye view of the relative performance of each of the individual sectors. Incidentally, home builders are not, I don't believe, one of those sectors that we cover. The ones we cover are things like utilities, financials, consumer staples, consumer durables, healthcare, technology, industrial, and so forth. So there's the layouts, and we also have explorations that allow traders to scan for pro-trend short-term buy and sell signals on any security with 4 years of data. So I have misplaced that comment because I'm going to talk about the special K experts. So number 5 is the special K experts, and number 6 is the explorations, which we'll get to after the experts. So the idea here is that we're using these experts to identify special K daily pro-trend signals. In other words, we're only looking at signals which go in the direction of the primary trend. So we can only get, when a bull market's in force, we don't get sell signals, we can only get buy signals. When a bear market's in force, we can only get sell signals. So we get short-term buy signals signaled when the long-term is moving in its favor. So the long-term is defined as bullish when the special K, and we're now looking at the daily template, is above its 100-day moving average, smoothed by a 100-day moving average. So that tells us we're in a bull market, and the short-term signals are triggered when the long-term is bullish, and also when the special K crosses above its 10-day moving average. So let's take a closer look at that. So here's the SPDR Metal and Mining ETF, the XME. And when the special K crosses below its moving average, that tells us the special K is in a bearish mode. And when it crosses above, that tells us it's in a bullish mode. So there's a bear trend. And there's another bear trend signal just there with that whipsaw. And in between is a bull trend. So what I can do is I can shade these areas to give us better perspective. And we have a whipsaw position in the middle here, but by and large, when it crosses the moving average, it means what it says. So you can see that when this special K is above its moving average, we only get green highlights. And the green highlights occur when the special K itself crosses above its moving average, its 10-day moving average, and it stays in force until it crosses below its 10-day moving average, which is a sell signal. So here's the thing in greater detail. So I'm going to give you the bullish period and the bearish period just here. So the expert's going to signal when it's in a bullish mode, it's going to be a green highlight. So here's the 10-day moving average. The blue line is the 10-day moving average. So you can see that when the price, when the special K crosses above its moving average, we move out of a black highlight, which is neutral, into a green highlight. And then it moves back into the black as the special K crosses below its moving average again. So it only signals short-term movements in the direction of the main trend. And there are two different experts. One looks at when the special K crosses above and below its moving average, and the other one looks at when the special K, I should say, changes its slope from up to down or down to up. So each of the experts comes with a commentary. So this expert here says the primary trend is bearish because the special K is now below its long-term moving average. The short-term trend is bearish because the special K is below its 10-day moving average. If you're thinking of going short, make sure that the market is not short-term oversold. And then the blue highlight of the blue comment tells you whether the RSI, 14-day RSI, is overbought or oversold. And then the black comment underneath tells you where the RSI actually is, because you can't see it on the chart. And it says it's between 36 and 64. And its current reading is 51. And then it says if you think you're going long, bear in mind that the closing price is below its 200-day moving average. So this was giving you a green bullish comment here, like up here, and the price itself was below its 200-day moving average. That will give you a warning. So finally, we simply have number 5, the experts that identify short-term buy and sell signals. We've also got some explorations that allow traders to scan for pro-trend short-term buy and sell signals on any security with 4 years of historical data. So in other words, we've got an exploration here which helps you identify from 2 or 3, 4, 5, 6,000 stocks which ones have just triggered a short-term buy in a primary trend bull market. So I think that completes what I have to say. I'd be happy to answer any questions that you may have at this point. Kurt's asking here, how does this historical data merge with the user's daily downloaded data? Well, what happened is I merged the old data, the historical data, with a Reuters symbol. And also there's two versions. There's one's Reuters and one's Trade Center. And it's also merged with Trade Center. So you've got the right symbols to just update it as you would on a normal end-of-day update. Anybody else got any questions? Mary, does it work on stocks? Yes, it certainly does. The package only contains sectors, but it does work on stocks, and it works on any freely traded security. And where it doesn't work would tend to be where you get these linear trends, which are as I mentioned, don't happen very often. Can you use it for intraday, like 1 minute data? Not really, because it's designed with a specific time frame in mind. So you either use it with daily data or you use it with weekly data. It probably could if you came up with the right formulas, but my experience of these very short intraday charts is that they are subject to a lot of random noise, so I much prefer the longer term charts. Can you backtest it? Good question. Yes, you could put the formulas in a system tester and you could backtest it. I've never done it because I tend to use this as an art form rather than as a systematic form, because that's how I regard technical analysis. I've defined so many systems, and I've never found any that really work unless they're based on monthly data. Any more questions? I'll turn back to Dave. Id. Oh, the formulas are available. There's no secret. They're in the package. The package comes complete with all the formulas for the weekly and the daily special K. It also comes with the relative strength, so you can plot the special K against or the securities against the world index or anything else. It's a one-time package fee, and then you have to update. Someone asked, is it a subscription or one-time fee? It's a one-time fee, but then then you have to update the data. So however you update the data is your other fee.
Yes, in fact, Martin, and thank you so much. Really a spectacular webinar. I'm sure everybody here is in agreement, it looks like. Right now on the screen, you'll see the purchase option for the Special K plugin. As a special offer, right now, we will take $100 off of that. So what we want you to do is go to this website that you see right here on the screen, or give us a phone call directly if you're in the United States or Canada, and let's get one out to you. I think you can see right away some of the power behind this plugin. It's one of our best selling, and certainly with the commentaries and the work that Martin has put into this plugin, it's a lot like having Martin Pring right there with you, walking you through some of these strategies. So it's really a powerful tool. We hope you'll take advantage of that. Thank you so much to Martin for the presentation today. Thanks to all of you for taking some time out of your schedules to be with us. We will go ahead and make a copy of this webinar for you to view at a later date, and we'll certainly make you